I made $895,000 in the past 3 months, and in this video, I'm going to show you how I've been selling put options to create consistent income month after month, quarter after quarter, and year over year for the past 10 years after working for Goldman Sachs, getting a degree in finance economics analytics, and basically having really good results selling options. I want you to have consistent and similar results to me, so here's a masterclass on selling put options. So firstly, selling put options can generate consistent income by collecting premiums from buyers who pay for the right to sell you a stock at a predetermined price. As long as the stock remains above the strike price, the option expires worthless, and you get to keep the premium as a profit. This is how to achieve consistent premium selling options. Now, I personally go for a delta of 32 to 37 on average, and I'll explain to you why shortly. But first, I want to say why this powerful strategy has actually been working in the market for so long. Because many people think that you have to keep mixing it up and doing something new and interesting and buy options. The fact of the matter is you can just sell put options and make a consistent income. I have many students that are making a full-time income, whether it's 5, 10, or even 15K plus just by selling options, not really doing any other strategy besides selling puts. Selling put options is a great way for strategic entry into a stock at a discounted price. Selling a put option allows you to potentially purchase stocks at a lower price than the current market value. If the stock price falls below the strike price and the option is exercised, you are obligated to buy the stock at the strike price. I'm going to explain to you why shortly that this is not really a problem whatsoever. I'm going to pull up Apple right now. Apple is going to be one of the example stocks that I use, but I'm also going to go through all the other positions that I do have in my portfolio. You can even see right now that I am selling Apple puts at the 215 strike, and Apple is currently at 227. That means that if Apple falls below 215, I'll be forced to buy shares. So I currently have 5 contracts open, so that means I'll have to buy up to 500 shares, but I'd be pretty happy to do that. The reason I'd be happy is because I actually want to own more Apple. I'm effectively getting paid through the premium that I receive through the put option to buy the stock at a discounted price. Because Apple is currently at 227, I have sold a 215 put option, so I'm happy to buy it at 215. Now, when you go to sell a put option, something scary will occur, something that people don't really understand, and they think that this strategy is crazy. But the fact of the matter is, it's anything but crazy. It's literally the safest strategy. It's actually safer than just buying stocks. So check this out. Let's say I go for an option that's expiring sometime in September, okay? And I go to sell a put option. Let's just say I'm going to sell the, 210. 210 right here has a pretty low delta, 14, so it's a little bit lower than I typically go for. Now check this out. The max profit's 141 and the max loss is 20,000. You might say to yourself, oh my goodness, I can lose $20,000. No, that's not possible. That is only possible if Apple goes to zero. Now, Apple is not going to zero. I can bet 99 point many nine infinite nines that that's not going to happen because Apple as a brand, it's a company that has been around for so long. So this is only the max loss if the stock goes to zero. The fact of the matter is Apple can't even fall 50%. It is so unlikely to happen. The chances of Apple falling 50% are probably the same chances of your house getting hit by lightning. So in reality, you are tying up $20,000. Yes, you need to have this collateral when you're selling put options. There's ways around it. I'm going to cover a little bit later in this video. But more so, you have to put up a lot of capital to make some money. This is normal because this is a very safe strategy. If you want a riskier strategy, you can bet small amounts of money and make large amounts of money. But just like everything else in life, you get paid in direct proportion to how much risk that you take. The reason why it's asking for so much capital is because the risk is actually very small. In fact, I would argue there is no risk at all. Now, why would I say there's no risk? Well, because you want to get assigned on Apple. So the worst that can happen is you get assigned, but that's already going to be cheaper because I sold a 210 put than owning the stock. So because it's already cheaper than buying the stock, it's actually zero risk versus buying the stock. Because in one scenario, you buy stock for 227. Other scenario, you might have to buy stock for 210. That is a double win right there. So it's really pretty hard to lose money on selling put options, specifically because you're going out of the money, you're getting paid for it, and worst that happens is you get to buy a stock and then you can still generate money on stocks that you own. Now, what I like about the selling put strategy is you have a defined risk with potential for pretty high returns, or at least medium returns. Selling put options provides a defined risk because your maximum loss is a strike price minus the premium received. So right here, you can see I have a 210 put option. I'm receiving 131. So my break-even price here, you will see, is 208.64. That's because I'm taking 210 minus 131, which would actually be 208.69. But Robinhood is a little bit off right now. This strategy can offer high returns because the premium can actually get pretty high if you're looking at high implied volatility stocks. Now, a high implied volatility stock would be a little bit riskier in itself, but if you look at something like Nvidia, for example, you can see here how the implied volatility on Apple is 25.88, but on Nvidia, it's definitely going to be higher. And that's because Nvidia as a stock has more volatility. It moves up and down more. I'm currently running an iron condor strategy on Nvidia and selling some put credit spreads. These two trades were given in my Discord community. So things are going pretty well there. This is a small account trade. But, let's go to trade Nvidia. Let's go to sell. Let's go to put. All right, I'm going to go for the same expiration date that you just saw for Apple. And, if I sell a put option that's out of the money, let's just go for 120 here, and I expand this option. The implied volatility is like literally triple. I mean, it's almost triple here. So implied volatility is triple. Now, if you're asking yourself, hey, the delta is a little bit higher than what you were looking at, the delta doesn't really impact implied volatility too much. So if I go down to 110, you'll see that the delta here is now much lower, but the implied volatility is still the same. So implied volatility and delta are pretty independent variables, meaning they don't really influence each other that much. So implied volatility here is going to be a lot higher, and that's why the premium here is a lot more. So if I go to continue, you'll see that I'm getting paid now more money, so 293 on a max loss of 10,000. Again, this 10,000 is if the stock goes to zero, which again is just not going to happen. Okay, so yes, Nvidia can pull down 10%, 20%, maybe 30%. Unlikely. So you're really only risking a lot less here. Okay, but because in theory, if it were to go to zero, this is how much you would lose. Robinhood is required to put that. So I would not really look at max loss and start to get fearful or afraid. This is just a hypothetical number here. All right, so 293. And the capital you tie up is 10K. This is actually a 3% return in about 34 days or 30 days, okay? So this is a lot more premium, and you're collecting more premium because of implied volatility. Because the volatility is higher in Nvidia, you are getting compensated more for the risk that you're taking. Everything in life is basically a risk and return. So here, there's higher risk, therefore there is bigger return. Now I'm going to explain to you why small returns are better than big ones. That sounds weird, but I've been doing this for 10 years. I've had a lot of consistency, been able to travel the world, and I'm still traveling full time because of my portfolio. A lot of my income comes from my portfolio's consistent returns, and I could live on my portfolio forever, because even a 1% return on $3 million would be $30,000 per month. Many of my students are getting 4 or 5%. It just varies on how much risk you want to take. This is what I teach in my program. I teach you how to fully understand option trading for yourself and make consistent income in my 6-week bootcamp. If you're interested, it is the first link in the description. But I want to explain to you what I'm personally doing right now and how my portfolio generated over $200,000 in 3 months. And that's because I'm personally focusing on several things. In my own money, in my own portfolio, I'm focusing on a little bit smaller returns, and I'm trying to be extremely consistent and never have a losing month. Now, part of my portfolio is also small trading, which adds a lot of value to my overall portfolio, because even if I take 5% of my portfolio and I double it in a year, that's going to be an extra 5% per year. But for the majority of my money, I'm focusing on small wins on every single weekly or monthly basis. Let me explain to you why I like small returns so much. And this is something that I've actually never covered on my channel because it's not so sexy to say. Some people might say, oh, I want the fast money. Well, for me, it's not about fast money. Most of my students are actually engineers, they're business owners, or they're working in an office and they just want to turn 50 or 100K and they want to go to 200, 300, 400K. They want to get to retirement. So that's exactly what I've done. I've grown my portfolio fast, but I've taken on a lot of risk. I would say that if I were to do this 100 times over, I probably would win 70 out of 100 times to grow a portfolio quickly. But if I were to grow a portfolio at a steady rate, I would do it 99 out of 100 times. So what I like about small returns is the reduced risk and reduced volatility that you get in your portfolio. So if I go back to my portfolio right now, you will notice that in the past 3 months, my portfolio has some volatility, but it's really not that much. Although this chart looks kind of scary, it went from 3.1 million, 3.173 at the top, to basically 2.9 at the bottom. So it's a 200K difference on essentially $3 million. So the swings are just not that big. And mind you, this is just a typical 3 months for me. I try to go for 3 or 4% per month in returns. I'm typically aiming for 1% a week, but sometimes that's not always possible with the market, and I'm only human. Some people will promise the world. I'm just trying to be realistic here. I'm using mainly tech stocks, so Tesla, I like American Airlines a lot because it's a smaller cap stock that is easy to get into. It's great for my coaching sessions. Tesla, Bank of America, Chipotle. I had Lululemon. I actually had a position that just expired that was profitable. Apple is my biggest position. I have Walmart, PayPal. PayPal I have done pretty well in because it has swung up a lot and I bought it in the low 60s. So I'm always looking for compounding returns, compounding benefits with reduced volatility. So smaller, consistent returns often come with lower risk and volatility. So big returns can be really enticing, but they usually involve taking on higher levels of risk. And for a majority of my students, they're in their older age. 50 and 60-year-old folks is who I typically like to work with. These are folks that are approaching retirement. They want a consistent income. They want to be financially free. They want to potentially leave their 9-to-5 job. Maybe they're already retired and they just want to increase their retirement income. And that's why I focus on consistency. Because when you have big returns, it's enticing, but it's not so stable. So the strategy that I like is more so medium returns, especially when the market is stable and in a rising market. When the market is crashing or it's bearish, I do a lot of hedging in my portfolio. But what I like to go for is repeatedly collecting premiums, usually without even owning the stock. I just sell put options. That gives me the returns. And with those returns, I'm just essentially either reinvesting them or I'm, taking them out of my portfolio. Consistent small returns can help preserve capital as well because it's pretty hard to lose when you sell out of the money option. In fact, anything out of the money is going to have lower than a 50 delta. And at the money option has a 50 delta. So if you go for anything out of the money, 40 delta, 30 delta, by definition, a 40 delta means that you have a 40% chance of getting assigned. A 30 delta means you have a 30% chance of getting assigned. So that's the fantastic thing, is the chances are less than 50. So that's good, right? And the chances are already low, and then nothing bad can really happen because you just buy the stock and just hold the stock and wait for it to recover, even if it goes way into the money. So you get a lot of compounding benefits. You get small and steady returns that compound over time, leading to significant growth in the long term. I'm a long-term investor. Guys, I've been doing this for 10 years. I started at 19 years old with $2,000. I took my time. I added more money. I was still in college. I didn't even have an income. Then I had an internship, multiple internships. I had an internship at Group 1 Trading, which is an option trading company. I had an internship at a hedge fund. I was getting paid okay money. I was making $75,000 a year. I would save my money. I was living in New York City. I was living in Los Angeles. And those cities were very expensive. So I was trying to put away $2,000 per month and I was adding it to my portfolio. Guys, I am literally living proof. $3 million right here. I have another portfolio with millions of dollars. So it's not the YouTube income or any of my coaching income, which I'm not going to lie, YouTubers make a lot of money. But I have another portfolio, which is worth millions of dollars. So this portfolio I haven't added any money to. This is just organically has grown over a decade, okay? It took me a long time, but hey, I'm a long-term investor. $3 million is more money than a majority of people have at age 60, 70. People never get to $3 million on average, okay? Even wealthier people. I have done this by just keeping track, just staying steady, by selling put options, by doing covered calls, by maintaining focus, by not getting emotional in market crashes, by dollar cost averaging. Psychologically, being there in tough markets and good markets, hedging in the bad times. Guys, this channel is a wealth of information for you. If you're watching this video right now, you are on track to get these type of results because these type of results are actually not anything extraordinary. It is just a function of time and proper strategy, and of course, adding money to your portfolio if you can. In the earlier days, I've added $100,000, $200,000 to this portfolio. Recently, I haven't because I don't want to have any more money in Robinhood, and I also want to track all my results here on YouTube. If I'm adding money, then my portfolio is going to get a lot larger quickly. So that's why I'm adding money in a different portfolio. This portfolio I'm organically growing, and I'm showing you guys a journey. This is literally my journey of over $3 million now. I've started with a much smaller amount. You can see all my older videos. And essentially, this portfolio has basically achieved retirement for me. And I think if you're going for consistent income, selling put options is the #1 strategy that you want to go because it gives you steady growth and you can actually outperform a majority of other strategies. You might not outperform every strategy out there for option trading because buying call options, bull call spreads, some of the other topics that I cover on this channel, they're more high growth, but they're also a lot higher risk. So over a 10-year period, you're going to be safer by just selling put options. It doesn't even make sense to learn anything but selling puts and covered calls. And those two strategies, by the way, look very similar because Let me show you an example. If I go to NVIDIA and I show you what selling a put option is, it's going to be very similar to a covered call. These two strategies actually mirror each other. So if I go to trade NVIDIA options, I go to, let's just say September 20th, okay? If you're watching this in the future, no worries. It's the same thought process. So I go to sell put option and I go for option right here. Let's just say I go for in the money or at the money. All right, this is right here. I can collect $925 for NVIDIA. But also, if I had 100 shares and I go to sell call option, you can see how the 130 call option is also right around $950, right? So basically, I'm tying up the same capital. So if I sell a put option at 129, I'm tying up basically $12,000. Now, if I do a covered call, so sell call, the 130 call right here is basically I have to buy 100 shares for $13,000, but then I get paid $1,000. So it's again $12,000. So you can notice that the market isn't stupid. They understand that you should be getting paid a certain amount of money depending on how much capital you're putting up. So there's actually not really a cheat code in options. You're getting paid directly how much risk you're taking. And because selling a put option for 129 is the same risk as basically owning 100 shares and selling a call option for also like 129, 130, all right, so let's go back to call, 129, 130, it's basically the same capital, the same premium you're collecting. So that's why in my coaching, when students will ask, well, should I sell a put option or a covered call? Very, very similar. But let's focus on selling puts because I have other covered call videos and I'll drop them in the description and I'll have them at the end of this video. Let's talk about psychologically and how you should manage positions, risk management. Topics like this, because this is a masterclass video on selling put options, creating income. And something that's really important is improving your psychological comfort with selling put options and staying very disciplined, because this aspect is what makes consistency. If you panic, you will lose. So pursuing small, consistent returns will help investors maintain discipline and stay committed to their strategy. That's another reason to go for small, consistent returns. When you go for big returns, you have a spike in your emotions. It might distract you. It might make you make a mistake. If you have small, consistent returns, it's almost unnoticeable. But over a long period of time, it compounds to huge numbers. That's basically what compound interest is. For example, compound interest is so interesting. If you have $100 and you make 10%, that's $10. But in the next year, if you make 10% more, now it's on $110. So that's going to be $11. One more time. In the third year, you had 110, right? Then it's $11 more, so now it's 121. In the third year, you have 10 more percent, but now it's going to be $12.10 more because it's $121. So 10, 11, 12.1, and then it just continues to increase. And I'm telling you, in year 10, year 20, the amount of money that you're making is more than the money that you put in. That's why I put in $2,000 and I added to my portfolio up to like $400,000, and boom, portfolio's at $3 million. Took a decade, but hey, a decade is not too bad to get to $3 million, which can generate, even 2% a month, $60,000. $60,000 is enough to live in New York. It's enough to live in Tokyo. It's enough to live in Dubai. It's enough to live in really expensive countries. So you're able to make a full-time income well below $3 million in assets. You can make a full-time income even with $500,000. Make 2-3%, that's $15,000 a month. So chasing big returns can lead to emotional decision-making, such as panic selling or over-leveraging. I do sell puts on margin, but that's not a topic I cover on YouTube because it's a more advanced topic. And on YouTube, there's a broader audience, and I just can't teach this topic because you can get in a lot of trouble with it. So a strategy that I mainly focus on is smaller, more consistent gains. That's much easier to stick to. And I do it on a long-term basis. So I'm selling options on a monthly basis typically, but a lot of people can also sell weekly options. I wouldn't say that one is better than the other. And also I like to go for steady because just imagine a long trip to work or something. Let's say that you have a commute to work. I always tell students this. That are like, I want to get to retirement faster. That's fine. You can aim for that. But think about driving at a steady pace of 60 miles per hour going to work. You're probably going to be in a good spot, right? You're probably not going to get in an accident, hopefully. You're not going to get a speeding ticket, and your car is probably not going to break down. Now, if you were to drive 120 miles per hour, now you have increased chances of getting into an accident, getting a speeding ticket, potentially hitting a bump on the road and something bad happening. And that's the same thing with money, okay? If you go for a steady, consistent growth, it's like just driving to work. You're gonna get to your destination. In rare cases, maybe you'll have an issue. And by the way, one of the issues is another bad driver. That's one of the risks that is out there on the road. one of the risks out there in the stock market is a stock market crash. So you can't really predict that behavior. Like you can't really predict somebody swerving and they drank in the morning and they hit your car. I mean, that's an awful situation to be in, but you can't predict that the person next to you just drank and they're drunk driving, right? That's not something that they're supposed to be doing. That's very unexpected. The same thing with a stock market crash. We cannot predict it. Therefore, we don't try to time the market. Selling put options can be a smart strategy for individuals with a $100,000 account looking to retire, especially considering some of the typical financial pain points that most Americans face. You can have less money, absolutely. You can even start with a 20K portfolio, but ideally, the more money you have, you're going to collect more premium. That is just pretty obvious, just like real estate. The more money you have, bigger house you can get. Same thing with options. The more money, the more premium that you can collect. So a lot of Americans and folks that I work with in US want another income. They want to supplement their income and get more consistent cash flow because wages have not really gone up as much as inflation has gone up. And they're lying to us about inflation, but that's a different story for one of my more general stock market videos. When it comes to selling put options, I think selling put options is the best income source for supplementing your income. Now, selling put options alone, you won't be able to just leave work if you have 100K, right? Because you want to save up more money. But along the journey of getting to 500K, $1 million, which is possible for anybody over time, it's the best way to supplement your income. In the meantime, and then as you learn this skill along the way, basically once you hit a certain amount of assets, you already have the skill. That's how you retire. You already have the skill, you already have the capital. And it takes time to get there. You can't start with $1 million because you're gonna mess up. And by selling put options, you actually mitigate the risk of buying stock at a high price because when you sell a put option, you get a much better price because it's an out of the money option. So for me, I go for delta of as low as 0.2, right? So 20 delta means that there's just a 20% chance of the option expiring in the money. So that's as low as I'll go. And actually I'll go much higher than 32, 37. Sometimes I'll even go for 40 if it is a low volatility stock. So a stock that has low volatility, perfectly fine for me to sell options that are much higher delta. Like take for example, Kraft Heinz. Kraft Heinz is a very stable stock. If I go to the 1-year return on Kraft Heinz, stock is just up 7% per year. So you could actually find many good entry prices into Kraft Heinz. And since it's so stable, you can definitely go for a much higher delta. You can go 40-40 delta. That just means the chance of getting assigned will be much higher, but Kraft Heinz is just basically a slowly positive moving stock that is basically always rising over a 5-year period. You can see that has so much stability. So when people say like, options are risky, they're anything but risky if you know what you're doing. So you can sell put options here. You can have so many entry points into Kraft Heinz, many entry points. You can see like one big fall. It's not really a big fall. It just went from 44 to 33. If you sold a 35 put option, you would get assigned. If you sold another 8 put option, you would get assigned here. If you sold a, even right here, you sold a 32 put option, you get assigned. So you get assigned over and over again, and you're basically building up your favorite stocks. You're getting paid to build a long-term portfolio. That's what selling put options is. You're taking on some risk to get assigned, which getting assigned isn't even bad. Someone else is paying you money because they are buying insurance. They're essentially buying crash insurance, but you're there saying, hey, I don't care if it falls. I want to get paid. Give me your money. I'm happy to get assigned in the stock. So let me quickly go over some really good stocks to sell put options on. First of all, American Airlines, the support level is around $10 per share. I would sell $10 put options on American Airlines. On Tesla, I have a $200 put. Anything out of the money is going to be good because selling out of the money options is profitable. Therefore, Tesla $200 put will be good. 205 put will be good. You don't have to go for 9.6 like me. You can go for September expiration, October expiration, anytime in future history. If you're watching this in 2025, in Tesla's at, let's say it's at $220 per share, you can still sell a $200 put. If it's at $300 per share, you can sell a $280 put. You can sell a $140 put. As long as you're selling out of the money options, that's where the money is made. That is the top strategy that I can recommend for you. Obviously not a financial advisor. This is just a guy on the internet that has billions of dollars that has 10 years of experience, right? But I'm not licensed. Amazon, 165 put, all right? That's what I currently have. Bank of America, I want financials because as interest rates fall, financial companies will do better. So I'm actually about to buy a lot of financial companies. Chipotle, I like the brand a lot. They only have 3,000 stores. Starbucks has tens of thousands of stores. So I think, and same with McDonald's, I think that Chipotle, as they open up more stores, gain popularity, I think the stock will do very well. So I have sold puts on Chipotle. I've also sold covered calls, which is called a covered strangle strategy. You can find my strategy by doing covered strangle, invest with Henry. Type in that key phrase on YouTube and that video should come up. Now, selling put options on Lululemon. I think that some retail companies can do very well, specifically Lululemon, because they have a more premium product. They have fallen a lot, so I'm a bit bullish on that. Google, I'm selling puts. Obviously, we're using Google right now. You're watching this on YouTube, which is owned by Google. I have many more picks. If you want to see my picks, all my trades, get my coaching, it's always the first link in the description. I open up 7 to 10 spots per week, and the bootcamp only has a maximum of 10 spots, and I run that as of right now on a monthly basis. So 10 spots per month. If you want to learn more about it, click the first link and you can learn more about my programs and Discord. Here's a video on the screen right now that I think will help you maximize your premiums and make more money. So keep watching, keep leveling up, make some money, and I'm here for you to help you get consistent income trading options.